What if I was to show you a way that you could make 2 to 5 points a day, 4 out of 5 days a week, using one simple method? What would you call that? Well, we call it a home run. This methodology is based upon a well-established fact that comes as a result of the initial balance calculation. Let me explain what we mean. Initial balance is nothing more than the high and the low of the first hour of trading. So 1 hour into the trading day, the initial balance is established. Now what's interesting about this is that as a rule, the market will move at least 1 standard deviation away from the initial balance. So let's illustrate this. On this particular graph, the white line represents the initial balance, the high as well as the low. That's your initial balance calculated after the first hour of trading. 1 standard deviation above or 1 standard deviation below is illustrated by this cyan colored line. 2 standard deviations is the red line. As a rule, the market will move at least 1 standard deviation from the initial balance levels. So whether it's going to move up or it's going to move down, of course, depends upon the trend. So what we're suggesting here is that you can play the spread between the initial balance and at least 1 standard deviation 4 out of 5 days a week. And we only say 4 out of 5 because not every day succeeds at reaching that first standard deviation. And in many cases it goes even beyond the first standard deviation. But all that we want to do here is to try to play that spread. Can this be done? Oh, absolutely. Absolutely. And once you have the proper indicators to do this, you'll see just how consistently this works. We measured, for example, a 2-month period beginning in June of 2014 to the end of July, and there were only 8 days, only 8 trading days in that period of time where the first standard deviation was not met. Now that didn't mean that you were going to lose money on that day. It's just meaning that that particular play didn't materialize. So what we do is we play this spread using the methodology that's found in the Pro Trader approach. So let's quickly give you an example of this. We're going to pick a day here. Let's pick, we got this set up for your illustration, or for your demonstration, I should say. Okay, we're going to pick this, the 10th of July as well as the 11th, the 10th and the 11th. And we'll use our typical methodology to show you how to enter a trade on these 2 particular days. Now the initial balance on the 10th, the high was at 1954.25. And 1 standard deviation above that will take you to 58.5. That's not a bad trade. That's a 4 point trade, and one that is certainly well worth taking. So how could we do that? The methodology that we use, as we disclose in ProTrader, is number one, identify the trend. Number two, identify the contrarian entry. In other words, if we have an uptrend such as we do have on this day, we're going to look for an oversold condition after the first hour of trading. Let's see how this. So number one, we're going to confirm the trend. And our indicators all confirm that on this particular date, the trend is up. So here's our initial balance at 54 1/4. This first standard deviation is at 58 1/2. And that's the spread that we're going to try to play. So we're going to look for the contrarian sometime right after the initial balance is established at 9:30. And we'll know instantly what that first standard deviation line is as soon as the initial balance has been established. So how do we find the contrarian? Here we are, 9:30, and the contrarian is displayed right there. We're in an oversold condition, and all we have to do now is go to the premium and the ticky to look for the exact timing of our entry. At best, we're going to get a fill somewhere around 52 to 52 1/4. Okay? Now, keep in mind that the spread was at 54. All right? That's the initial balance is at 54. And your first standard deviation is at 58. And in this particular case, you're able to get in that trade somewhere around 52 to 52 1/2, worst case scenario. So you've just added another 2 points onto this spread by virtue of the pullback that happens right there after the initial balance is established. And you write it up. You write it up. Nice move, and that doesn't even take you 30 minutes in this particular case. It's not bad. It's not a bad day's work. Not at all. What if for some reason or another you decide to pull this trade and you want to get in again because it hasn't quite made it to the initial balance yet? Do you have another opportunity to trade this? Sure. Here's another contrarian. Got an oversold condition right in here. Now it doesn't happen to pull off the full move, but it's a successful trade. 56 up to 57 1/4. Yeah. 4 ticks. Or another opportunity to get in here or at the divergence shown over here and ride that thing up. And sure enough, it works. Not bad. That's a home run. Let's look at the situation on the 11th. All right, now on the 11th, our initial balance, the high, is at 1960. One standard deviation above that will be at 63 1/2. So sometime after the first hour of trading, we're going to look for the contrarian to go long. Our procedure is very simple. First order of duty, we need to confirm the trend. Now after 9:30, all right, just after 9:30, that trend begins to become more clear. We have an upslope on our primary indicator, which is then further confirmed by the other 3. So we're going to look for an oversold conditions sometime after 9:30, after the trend is established, and look to go long, keeping in mind that we're holding that trade with the intent of it reaching the first standard deviation. And keep in mind, we don't know that the trend is positive until just before 10 o'clock. 9:51 on this particular chart, we see confirmation of an upward positive trend. So let's look for the contrarian. The first opportunity to get into this trade occurs after 10 o'clock, right in here, where we are in an oversold condition. We do have a little bit of divergence there, as shown by our indicator here. But by way of our market profile, we also knew that our low value area is down here. But we could certainly give this a try. So we enter the trade right in here. We check the premium and the ticky. We won't go into that right now. But what happens? As we teach, when you are below the point of control and you're moving up to the point of control, if the highs don't break through much beyond and the lows don't get above that point of control, then chances are this is not going to succeed. But we have to give it at least a try. So we might enter that trade at about 56. We make it up to a little better than 57 and a half, and what happens? We get overbought and it ricochets down to the low value area. So we would have an opportunity to pull a stop and break even, worst case scenario, maybe make a couple of ticks off of that trade, but we're going to give it another try. And over here now, at around 10:24, we get another situation where we are oversold. There's your contrarian, and you're going to move up, hoping to get this trade off toward that 63.5 goal. But keep this in mind. You're not entering it at 60. You're entering this trade down here when it's just under 1955. For it to move up to 1960, which is your initial balance line, that's at least a 5-point move right there. Not to mention the additional 3.5 points that you're liable to make as it moves toward the first standard deviation. So now I think you'll probably see, this is why we call this a home run. That's a good trade. All right, so what can happen here? All right, we get into that trade, and keep in mind we got to have those lows above that point of control. Doesn't make it, so sure enough, we begin to drop. But we made something out of that trade. Entering in at 55, exit around 58. You know, that's a 3-point move right there. You've already made 4 points just on the volatility, not to mention where you're ultimately headed. So you give us another shot. And over here, you get into that potential situation where we're, again, oversold. Volume is beginning to increase, so we move into this. We get a little divergence there, and we get into that trade at around, worst case scenario, 55.5. And it doesn't quite get us to where we're going just yet. And so even if we needed to enter this trade again, we could do so based on a positive volume and give it another shot. And sure enough, we're entering that trade even at 55.5 to 56, riding it all the way up to 60. All right, all the way up to 60. So we practically made 9 points on just the volatility here. And then toward the latter part of the day, it runs all the way up, almost makes it to our first standard deviation. But you've made a lot of money on this trade because you know where that spread is and where the market is headed. That's why we call this the home run. And I'm Rod Kusin, Spoonman for Risk.